Hi everybody, and welcome to this final video in this series exploring Theme 4's 4.4, the financial sector. Now, so far, what we've done in this series of videos has been a video which looked at the roles of financial markets, which is 4.4.1, which was things such as facilitate saving, to encourage lending, exchange, to look at forward markets, but also equity markets. There was also another video which looked at market failure in financial markets, so problems such as negative externalities, moral hazard, asymmetric information, market bubbles, and market rigging. Now, what this final video will look at is 4.4.3, which is the role of the central bank. Okay, so just to get you warmed up with this stuff, please, on your screen now you can see 6 different questions all linked to this one big overall question linked to question 1. So what I want you to have a go at, please, is writing down your answers for these questions. Let's see what you know about the role of the central bank already. So what I'd like to do, please, can you hit pause now, put down your answers, and once you've put down your answers, hit play, please. All right, so hit pause. Right, everyone, welcome back. Now, just to give you an overview then of these answers for these questions, clearly the UK Central Bank is the Bank of England. Now, B, I've put who is the governor of the Bank of England. So our central bank is the Bank of England, and the person in charge is a gentleman called Andrew Bailey. And I'll show you a photograph of what he looks like in a moment or two. Now, the Monetary Policy Committee is made up of 9 independent members. Now, what these 9 people will do, they will meet up on a monthly basis to decide on what the Bank of England's monetary policy should be. So we could link that to D, which was what is the key macroeconomic target for the Bank of England. Well, the idea is the Bank of England have been tasked with keeping inflation as close to the 2% target as possible. So their overall objective is price stability. But they have got one eye on things such as economic growth, unemployment as well. And they'll even keep one eye on the exchange rate as well. So when the Monetary Policy Committee meet, they're deciding on what they think needs to happen to monetary policy. So what should happen to interest rates, for example? What should happen to quantitative easing? Does there need to be any kind of management of the exchange rate, etc.? Okay, now for E and F, I'm going to explain those by moving on to the next slide. Right, okay, so what we've got here then is what we call expansionary or inflationary monetary policy. Now, what we should be happy with, that monetary policy is the use of interest rates, money supply, and exchange rates to influence and support macroeconomic objectives. Now, look at that bottom left-hand diagram that we've got here. You can hopefully see here that we've got a negative output gap. The aggregate demand in the economy is Y1, whereas the potential output of the economy is based on the long-run aggregate supply curve. So there's a gap between actual GDP and potential GDP. Now, this is normally associated with a recession on the business cycle. So the economy is operating below where we would like it to be. So that means that GDP is lower than what we would like it to be, but it also means unemployment might be creeping up. And there's even that risk that we might even start to see some disinflation or maybe even deflation creeping into the economy. So what we've got to try and do through expansionary monetary policy, which is a key role of the central bank, is to inflate the economy. In other words, make aggregate demand move outwards. Now, we could do this by reducing the base interest rate. Now, the base interest rate is the interest rate that the Bank of England will charge banks to borrow from that. So the logic would be, if we were to lower the base interest rate, it means that banks can borrow from the Bank of England at lower interest rates. So if they can access money cheaper, it should mean that you and I can borrow money at lower interest rates. It means that businesses can borrow at lower interest rates. Now, what we can also do is to use something called quantitative easing. And we'll worry about that one in a moment or two. Let's just think then what should happen when interest rates fall. What we'd expect to see, first of all, is an increase in consumption. The reason being that if interest rates are falling, the returns being made available to savers is falling as well. So there's less incentive to save money in banks, and that will increase people's average propensity to consume. Now, further to this, if interest rates are low, then it's more likely that more households will borrow from banks to fund more consumption. This could be to buy a bigger, better house and a mortgage, taking out a loan to buy a new car, paying for things on credit cards, so it will increase consumption. What it would also do, though, it would also increase investment, with the logic being that businesses often need to borrow to fund additional investment into infrastructure, such as capital. So the logic would be if they can borrow cheaper, firms also become more willing and able to invest. So what we'd expect then, when you've got more consumption and more investment taking place, there would be an outward shift in aggregate demand. Now, what you also need to be aware about, though, is something called quantitative easing. And ultimately, what we're doing here, we are increasing the supply of money. Now, look in the bottom right-hand corner, what we've got here. I've tried to give you here a diagram which shows how quantitative easing can be used to help stimulate an increase in aggregate demand in the economy. So the idea would be that the central bank, in our case, the Bank of England, they will create digital money. They don't really print money, but the additional money, they will just create digital money. And they will use this money to often buy mainly government bonds from financial institutions. So big finance firms, for example, in a recession, they might have lumped all their money into government bonds because they see it as a nice, safe, solid, stable rate of return, less risky than lending to households and firms. But the idea is, if the central bank starts buying more bonds from these financial institutions, it would have the impact of raising the price of these different bonds. And that has the impact of reducing the yield, which in effect is the interest rate on these bonds. Now, when that happens, bond markets become less attractive. And that raises the likelihood that these financial firms, rather than buying government bonds, will now look towards lending more to households and businesses. And that again encourages more borrowing by consumers, but also by businesses as well. And that should hopefully stimulate a growth in aggregate demand, create more jobs, and then boost overall GDP in the economy. So guys, when you look at the left-hand side diagram and this negative output gap, how inflationary monetary policy works is that when interest rates are cut and when we have more quantitative easing, there will be an outward shift in aggregate demand. And the economy would move back on to the long-run aggregate supply curve. Now, one thing that's also been worth aware of, though, as well, is that when the Bank of England do things such as raise interest rates, lower interest rates, I beg your pardon, when they lower interest rates, they're also where it will have an impact on the demand for a country's currency. Okay, now the idea would be if there's lower interest rates available on investments into the UK economy, it makes these investments less attractive for foreign people. And this would have the impact of lowering the demand for our currency. This will lead to the currency getting weaker. Now, this is bad for terms of trade because importing will now become more expensive. But the logic would be that because our currency is now weaker, the foreign currency price of our output overseas will now be cheaper, and that would raise the demand for our exports. So it's even possible that inflationary monetary policy could lead to an improvement in trade performance, which could also lead to aggregate demand shifting outwards. Now, this is a really, really good diagram to help you understand the impacts of inflationary monetary policy. So what we've got here is something called the transition mechanism of monetary policy. And what we're doing here, we're showing the impacts on the economy of a reduction in interest rates. So look what's going to happen. If we were to lower the Bank of England base rate, the interest rate, then the logic would be that mortgage rates would start to fall. So that would mean those with variable rate mortgage will see monthly repayments fall. People looking to buy their first home will also see their new mortgage costs be cheaper than what they were before. Now, this would then have the impact of reducing household spending on debt. If you're paying less for your mortgage, you've got more disposable income to increase your consumption of other goods and services. Now, the next line down, due to lower interest rates, the incentive to save will fall due to a reduction in the returns on savings. So people will save less, which will again lead to a growth in consumption taking place. Next line down, borrowing for investment is cheaper. So businesses can now borrow money for lower interest rates than what they could before, which would incentivize more firms to want to invest. So investment would increase. Next line down, when the interest rates are lowered, we've mentioned here something called hot money flows out. Now, all this is people investing in or out of an economy to get generally quite quick returns on investments. So the logic would be that if the UK were to cut their base rate of interest, foreign investors would view the UK as a less attractive economy to invest into. There's low returns available. So they would demand less of our currency. There'd be more outflows of money of our exchange rate. So that would lead to our currency losing value. And that will lead to imports becoming more expensive because of the weaker currency, and exports will become cheaper. Now, hopefully what you remember is that the formula for aggregate demand is C plus I plus G plus X minus M. Now, look what could happen in theory. If you lower interest rates, we're going to get a growth in consumption due to cheaper mortgages, less spending on debt, and less attractiveness of savings. We're also going to get an increase in investment because businesses can borrow at lower interest rates to fund investment. And if exports become cheaper, that could create export-led growth. And if imports become dearer, households might shift their demand towards more domestic goods and services. So higher consumption, more investment, an increase in export volumes, a reduction in import volumes will increase aggregate demand. Well, that will therefore shift AD outwards, so we're going to get a growth in GDP, and that will create some demand pull inflation. And we've therefore tackled that negative output gap problem. Let's now think about the opposite then, contractionary, or what we call deflationary monetary policy. Right, now look at the diagram at the bottom of the page. Imagine the economy is operating in a positive output gap. So we're operating at Y2 in that diagram. So the output of the economy is beyond the potential of the economy. Now this would occur on the business cycle based on the blue bit there. So that positive output gap situation. Now hopefully what you remember here is the economy is overheating. We've got scarcity of goods and services, and that will often mean that inflation is now too high. So what we've got to try and do is to bring down aggregate demand to close off that positive output gap. So what we would do this time, we would raise the base interest rate. We're going to make it more expensive for banks to borrow from the Bank of England. Now, if interest rates were to become more expensive, then households will find it now more expensive to borrow money. Mortgage repayments might start to go, so more income has been used to pay debts. Savings start to be expensive. So that would lead to a reduction in consumption, which would help bring in aggregate demand. But also higher interest rates would also make investment for businesses potentially more expensive. Higher borrowing costs would mean that firms will find it less attractive to borrow to fund investment. And that would hopefully, again, reduce aggregate demand. Now, what we could also do alongside this is to end that quantitative easing policy. So rather than the Bank of England buying government bonds, they can resell them again. So in effect, they're deleting that additional money that they created in the economy. Now, what we've also got to be aware of though as well, that when you raise base interest rates and reduce money supply, there's a good chance it would lead to your currency getting stronger. The reason being that as your interest rates increase, the hot money this time will flood in. So more foreign investors want to invest their money back into your economy to benefit from them higher interest rates. So the demand for your currency will increase. Further to that though as well, as interest rates start to increase, the logic will be that less of us will invest our money overseas, which would stop us supplying our money, and that would also help the currency get stronger. Now, as the currency gets stronger, we should be thinking is spiced. Imports become cheaper. We should now, in theory, buy more imports, and exports become more expensive for foreign people to buy, which would probably lower export demand. So this would also help reduce aggregate demand in the economy and close off that positive output gap problem that we might now have. Right, everyone, I've got a question for you to put down the answers to. Now, question 2, you've got here again the transition mechanism of monetary policy, but I want you to now think about what will happen when the base interest rates increase. Now, if I was to go back quickly to this, we can see here the impacts on the economy of interest rates being lowered. You can use that to help you, but I now want to think about what the impacts will be on the economy when interest rates increase. So have a go at filling in this transition mechanism showing the impacts on the economy of an increase in interest rates. So hit pause now, please. And when you're ready, you feel like you're comfortable with this theory, hit play, and we'll carry on with the rest of the video. Right, guys, now, as you've hit play, you can now see that there is an additional question that I want you to think about. I gave you a diagram earlier on in this presentation to show how quantitative easing can be used to stimulate economic growth. Now, what I would like you to do now is to put together your own diagram which shows the impacts of quantitative easing on the economy. So use a diagram to show me how quantitative easing can be used to stimulate economic growth. Right, hit pause, and when you're ready again, can you please hit play? Right, everyone, now on this page here, we can see the overall role of the central bank. Now at the top of the page here, you've got two different photographs. The top left one is the governor of the Bank of England. This is Andrew Bailey. The top right-hand corner shows the Bank of England. So this is the UK central bank and it's based in London. Okay, right, now look at this then. What we have for the central bank are four key roles. Now the one that we have focused on heavily is the implementation of monetary policy. It's one of the key roles of the bank to use interest rates, money supply and exchange rates to support key macroeconomic targets. So what we know then is that if inflation is too high, interest rates will be increased. If inflation is too low, interest rates might be reduced. But it's also been worth aware that money supply can be adjusted through quantitative easing. But on top of that as well, we might sometimes deliberately manipulate our exchange rate. And that could again be used to support key macroeconomic targets. So one of the key roles of the central bank is to implement and use monetary policy effectively to support macroeconomic performance across the economy. Right, now another key role of the central bank is to be the banker to the government. Now, when you think about it, I need a bank account to pay my direct debits, to buy different goods and services from, but also to pay all my bills, but also to get my wages paid into it as well. Now, different government departments will clearly need bank accounts. Well, this is one of the key roles of the central bank. It's to manage those finances for those departments. Now, think about what will happen. The Department for Health, the NHS, they will receive a budget from the government to run its services. Well, that money's got to be stored somewhere. That's where the central bank can come in. And then from that central bank, they've then got to pay all their different suppliers for bandages, medical care, etc. They've got to pay their wages to their workers, so doctors, nurses, cleaners, different contractors. Well, that is why those bank accounts are really, really important. So the key role of the central bank is to be the banker to the government. Okay, so to provide that facility for government departments to store their money and then make payments from that bank account. It's also been worth aware though as well that the Bank of England can provide loans to the government, that they can buy government bonds through quantitative easing. So the central bank has got a key role when it comes to managing and looking after government finances, given the ability for the government to store its money somewhere and to make payments. Right, the next one is the banker to the banks. And I've put down here something we call the lender of last resort. Now, it's the job of the central bank to make sure that financial markets have got good liquidity. Now, all that means is it means that they can access cash when it's needed. Okay, it's about supporting stability across the financial system. Okay, so the idea will be, everyone, that when financial firms fall on financial hardship, then the Bank of England technically has to bail them out. It's the lender of last resort. So a good example, at the start of the financial crash, Northern Rock fell on financial hardship. they suffered from what we call a run on the bank, where everyone tried to withdraw all their savings from the bank at the same time. There were other problems with Northern Rock as well, but the idea was Northern Rock ran out of money. So the idea was the central bank had to bail them out. So provide that financial support to make sure they could meet their short-term debt obligations. So one of the key roles for the central bank is to ensure liquidity by being the lender of the last resort. Okay, so if financial firms fall on final hardship, the Bank of England will support them, get them through that time. Right, then finally, another key role is to regulate the banking industry. Okay, now you've been through lots of different financial market failures, asymmetric information, moral hazard, market rigging, speculative bubbles, externalities. Well, the central bank has got to try and limit these different market failures. So regulating the banking industry is a really, really important target. Now, within the Bank of England, there is something called the Financial Policy Committee, the FPC. And it's their job to regulate different banks to make sure that they are not creating potential problems in the economy going forward. So, for example, some of the things that they can do, they can conduct what we call annual stress tests on financial firms. What they do is they build up a computer model. They look at the finances of the bank, the debts these banks have got, and then they subject them to really, really extreme conditions. So, for example, a bank might be told, right, okay, well, would your bank be able to cope with 20% of your mortgage holders not making repayments next month? Could your bank survive a significant increase in unemployment or a drop in GDP? And then the idea would be if the banks don't pass these tests, then the Bank of England can implement regulation to make these banks more liquid, more safe. And this could be things such as making them increase their financial reserves. So, rather than allow them to lend every penny out to people they've got in their vaults, they've got to keep back a certain amount of money. In other words, what we're doing here, we are making them more liquid, which means if they fall on financial hardship because of what's going on in the economy, they've got the funds to sort themselves out. They haven't got to go to the government or the central bank to ask for money. They can tackle their own problems. Now, other things that the Financial Policy Committee might do as well, they might look at borrowing limits, what we call the loan to value. So, for example, one reason why Northern Rock got into so much problem was that they allowed people to borrow too much money to buy houses. So they were giving some people 125% mortgages, which meant that they were lending people the full amount of money to buy a house, but then giving them money on top. Now, that is exposing Northern Rock to a lot of risk. So if things are, looking quite bad or bleak in the economy, then the central bank could say to these banks, you can only lend 80% or 85 or 90% of the value of a property when people take on board mortgages. So we're making the banks more safe, more secure, if you like. They're less exposed to risk in the economy. What we might also do, though, is to prevent financial firms from exploiting people. So, for example, when it comes to payday loan companies who might charge people extortionate interest rates, we might cap the interest rates they can charge when they offer people these loans. Okay, so Financial Policy Committee, one of their key roles within the central bank is to regulate the banking industry, make sure it's working effectively to support good macroeconomic performance. Now, alongside that, though, you've got an independent body called the Financial Conduct Authority. Now, the central bank in Britain, the Bank of England, will work closely with the Financial Conduct Authority, the FCA. Now, look at what I've put down for what the FCA is. It's a watchdog designed to protect consumers, promote competition, and maintain financial stability in the financial services sector. So it's about making sure that financial firms remain liquid, they can access the funds that they need, they're not taking excessive risks, they're not building up potential externality problems, they're not contributing towards speculative bubbles, but also that there is effective competition in the marketplace. The logic would be that market rigging becomes a lot more difficult when you've got more competition between banks in the industry. Now, what that should do is to protect consumers a lot more. It's making firms act more competitively to give consumers the best deals that they can. Right, guys, now just to wrap up this video, you've got here question 4. Explain the roles of the central bank. So A, B, C, and D. So implementation of monetary policy, banker to the government, banker to the banks, so the lender of last resort, and how they regulate the banking industry. And you might want to reference there the FPC and the FCA. And then finally, explain the term liquidity. I mentioned the word liquidity a lot in the previous slide. So have a go at writing down your understanding of what you think we mean by liquidity. Right, guys, well, that's the end of the video. So I'll stop there and say thank you very much for watching.